Hey everyone, my name is Lee. I'm an engineer at Euler Labs, as well as doing some BD work. And I'm here to talk a little bit about the DeFi yield market, just kind of an overview and some of the kind of interesting risks and dynamics that have come into play over the last couple of years as it's approaching some more maturity. Title being picking up hundreds in front of a steamroller, kind of a play on the classic picking up pennies. But we'll just jump right into it. And also, none of this is financial advice. So talk a little bit about kind of a brief history of DeFi yield markets and lead into where we are today. Talk about what the risks of that are and how this might all blow up someday. And then talk a little bit about how Euler fits into all of that. So brief history of DeFi yield markets. So start with what is yield, and I'm sure most people are kind of familiar with what it is in general, but yield is essentially a payment to allow somebody else to use your capital while you don't have access to it today. Really coming down to time value of money. A dollar today is worth more than a dollar tomorrow, thanks to opportunity costs. I'd rather be able to do something now than I would in the future, but somebody else might pay me to make up for that. There's different ways to kind of assess how much you should be paid for that, and that depends on a lot of different factors, such as who you're lending your money to, what they're doing with it, how long you need to not have access to your capital, but all those things are kind of calculable risks. And then yields in DeFi in particular, there's certain things that I and we at Euler like to think of as more real yield, and other things that are, I would say, not so real yield. Real yields being kind of things coming from sort of the real world, being treasury yields, dividend yields, and also more specific to DeFi and crypto, things such as staking yields for proof of stake and validators and whatnot. And then there's things that are not quite as real yields, Terra Luna being one of the classic ones, and other protocols that we've seen over time where you have these kind of issuance of whether it's governance tokens or other kind of payment that is sort of floating kind of willy-nilly value, but people kind of like to think of that as a real yield, even though underlying it might not necessarily be that real. One thing that DeFi has done a really good job of noticing is that people really like yield and like to do sometimes silly things to get access to that yield. DeFi summer is what everybody always likes to remember, where you can be earning thousands and thousands of % APY on some silly tokens and making tons and tons of money and taking on a ton of risk to do that without either paying attention to it or acknowledging it and just not caring and doing it anyway. So I would say the kind of the peak of this was in the DeFi summer, as I said, and over the last couple of years it's settled down a little bit and started to kind of mature into a more developed market where risks or yields are starting to look a bit more real. People are starting to understand the risks a little bit better. We've had some interesting evolution over the years of what that specifically looked like. So it started with kind of this shift to the proof of stake system and the classic staked ETH versus ETH trade, where you're earning yield on your staked ETH against kind of an underlying ETH product without yields. But that's evolved over time because that trade kind of went out. The classic one nowadays is the points meta, so we can thank Blur and Blast and Pac-Man for kicking that off, and now everyone and their brother has a points program that they want to do, and it still works, so people are still doing it. And nowadays I would say kind of the yields are settling down in the sort of 20% range for stable coins-ish, 10-15% for ETH and 5-10% for Bitcoin, which is still not bad. It's pretty good. It's a good way to kind of put unused capital to use. So where does that bring us to today? There's a lot going on in the DeFi markets. There's point systems, there's kind of leveraged carry trade systems, there's Euler and Aave and Morpho and Pendle and real world assets, and the classic governance token trades and carry, and anything that you can think of, someone is doing it, and someone is doing it in a leveraged way, and building up bigger and bigger positions and earning more yield on top of it. But there's a lot of options nowadays. One of the things that's been very popular recently is sort of assets that are trying to breach into kind of more real world yield generation use cases, such as Athena or USR, where you have something that's an underlying spot versus a shorted perp against it to do sort of a delta neutral carry trade, which originates in the finance world. Kind of the interest rate carry trades are super, super popular, and we've seen them be very, very successful in DeFi nowadays. Similarly, we have a lot of these kind of staking-based tokens where they might have a time lock component to them that people are either not realizing or not paying attention to, or not sort of thinking about what the kind of risk associated with that might be, as well as more complicated kind of aggregated yield baskets that might look like sort of one thing where they're getting a nice juicy yield on it, but not really sure what's going on under the surface. But again, it doesn't matter because you're getting paid out a nice amount. And we're starting to see a lot more of these being used as collateral in lending protocols and other protocols to, thought of as kind of safe yield-bearing assets when in reality, a lot of these under the surface are really just kind of tokenized sort of funds and kind of discretionary trading strategies that are a bit more risky than they seem. Similarly, one of the other evolutions we've seen is a big focus on capital efficiency. And what we mean by that is kind of better ways to put capital to use so that things are not just sitting idly and allowing more of your assets to earn more yield, and everyone's making more money and we're all happy. So it definitely leans into where we're getting more and more degen in the DeFi space, as some of the yield numbers have been shrinking relative to what they were in DeFi summer, and people are trying to grasp at anything that they can. If I want to lend my collateral and somebody wants to borrow my collateral, that's better because I'm earning yield on my collateral, maybe double, and it's more efficient, and there couldn't possibly be any problems to this. And I'll repeat this until until I'm sufficiently leveraged for my personal risk tolerance. If anybody remembers the Wall Street Bets days, people are getting more and more, like I said, they're either not paying attention to the risk or they are and just ignoring it because the yields are too good. One thing that we at Euler and a lot of lending protocols and kind of risk managers do like to think about as regards to these sort of things is, how do these trades fit into the market as it stands? How do you think about sizing your positions? How do you think about the liquidity that's available on chain? What's an appropriate size? What's a not appropriate size for both an individual level and a protocol level? Primarily for these yield-bearing assets, or even the non-yield-bearing assets, or really anything coming into a lending protocol. And then thinking about kind of more unique risks at an asset level. So things that might have a time-based unlock or redemption period to them. And for now, as far as we've seen, people do a decent job of thinking about this and kind of gauging and sizing positions appropriately. As these markets mature more and more, we're starting to see a lot more institutional players kind of start to think about getting into the DeFi markets, which is going to be interesting as it grows more. I would say they're not quite here yet. But the size and the behavior of the institutional players is a little bit different from kind of how your traditional DeFi player works. We like to think about TVL and sizes in the billions, and they tend to think about sizes in the trillions. And it'll be an interesting growth of the market as we start to capture and sort of handle larger and larger sizes as institutional plays and RWAs move more and more on chain, hopefully, maybe. And just kind of seeing how the system can handle that over time and making sure that people are kind of positioned appropriately and ready for that. So where does this lead us to, and why is this risky and kind of worse than we all think it is? Like I said, bigger markets, bigger players, more and more people getting in and really grasping at anything they can to juice yields, pick up more returns. And as I started with, the classic kind of saying for, I would say, trades like this in the traditional finance world is picking up pennies in front of a steamroller, which sort of analogy for, you can find some tiny little yield and continue to, pick it up over time, but eventually you've got this massive kind of steamroller risk behind you that's going to come crush you when you're not expecting it. Fortunately for us in DeFi, the pennies are more like $100 bills, with yields being what they are relative to what you'd get in the normal finance world doing some interest rate arbitrage trade. And for now, it seems worth it. Like, if you can get a 20% yield on a stable coin and level that up 5x, 6x, and get to, 100% plus in your yields, why wouldn't you do that? As there's a risk that it blows up, but if it's a 0.01% risk, then that's kind of worth it at the time. So people are starting to more and more kind of leverage up and kind of take advantage of it while they can. We'll take a step a little bit into kind of the TradFi markets a bit. Talk a little bit about kind of the 2008 and what happened there. And it's sort of a nice analogy for kind of the way that the normal, the traditional finance system broke down and had kind of its own little explosion. As most people are familiar with, this kind of originated with mortgage-backed securities and subprime loans, and everyone thinking that these trades were amazing and safe and kind of structured in a way that could never possibly blow up. And then it did. S&P was down 50% over 2 years. We had trillions of dollars wiped out from the global economy, a massive recession. And it was sort of an interesting way in which that happened in the markets. It sort of was a built-up kind of understanding that things were going to blow up. And, talking with people who were on the trading desks at the time, it became kind of literally a mark-to-market standoff where everyone knew that all the assets they held on their book were not quite worth what they thought they were, but nobody wanted to be the first mover to actually take that hit, because they would have to be, the first one to take the loss, and then sort of knew that would start this margin call cascade across the entire industry, which, led to what happened, where we had the bankruptcies of the banks and kind of this giant recession that sort of impacted the entire world for many years following it. Now, what about DeFi? We've seen kind of tastes of this, I would say, over time. A couple of the big ones being, the Terra Luna explosion from a couple years ago, where, again, these were these massively leveraged positions and people with sizes that I think they were not prepared for, and liquidation cascades and unwind that people were not quite aware that was a risk. In hindsight, I think to everyone it seemed sort of obvious that this was what was going to happen. But at the time, again, it was too good to ignore. So everyone was in it. I myself was in it a bit, and I think that that's sort of the prime example. We've seen hints of it a couple other times recently, where we have these kind of yield-bearing assets, again, massively leveraged against these non-yield-bearing assets, building up risk to a level that people are not as aware of, even on just like the straight-up asset basis. And then when you start to pair that with these assets that really are leverage trades under the surface to generate that yield on them, you sort of get a multiplying effect of when a perp market starts to unwind, you start to have issues with assets that are relying on that perp market. And yeah, it could get ugly at times whenever this, whatever triggers that unwind. We're in the hundreds of millions now, but as I said, as this market continues to grow and we get into the billions and hundreds of billions that are in these assets, that gets very, very sort of explosive in a way that we're not quite ready for. Some other things that we've seen hints of it, there was the Barristone kind of risk or incident from last month where we had a little bit of market wobbliness on its own, which then led to people kind of getting scared and wanting to get out of any sort of locked ETH vault position, and that kind of triggered its own unwind, which triggers a depeg, which then triggers more unwind, and it kind of cascades upon itself. And then another one that's very topical and very relevant to the last couple of days is the Bybit incident, where fortunately it sort of didn't have any kind of cascading effects, but there's some serious chances of this being something that could have a heavy impact on assets that are relying on those things when you don't quite know where sort of the underlying assets are being held. So for instance, had one of these kind of delta neutral trading positions had everything held at Bybit loses all the funds, all of a sudden this yield-bearing stablecoin doesn't actually have any asset backing anymore. That blows up, depegs, and then sort of triggers a cyclical downfall from there. Again, talked about this a little bit, but like I said, over the last couple of years, we've seen people more and more willing to take on these risks and consider these assets to be safe, when in practice they're not quite as safe as they think they are. So we've seen kind of lending protocols continue to grow their caps, grow their sizes, which is great. We'd love to see more usage of lending markets and things like that. But I think there's sort of a little bit of a lack of awareness to the kind of true level of safety of kind of what's happening under the surface with these. Yeah, and sort of the big kind of thing that this comes into is when everyone starts to kind of do their own risk assessments and build their own positions, and from a protocol level start to think about how they need to think about the risk of these positions and what happens when they start to unwind and set LTVs and caps appropriately. It tends to be done, I would say, a little bit at kind of an individual protocol level, which is great for the protocol, but becomes less great for the protocol when there are 10 protocols also doing that, and everyone sizes their max unwind or max deposit at whatever they think the market can handle without realizing that everyone is going to be unwinding at the same time that they are. And that's when you really start to get into the cross-contagion risk where if everyone has to unwind, if 10 protocols have to unwind 100 million of some asset because there's 100 million of liquidity available in the market, then all of a sudden you've got $1 billion trying to sell into a $100 million market, and you start to look elsewhere and kind of hedge that risk or sell out of it appropriately, and everything starts to tumble together. This is, not necessarily specific to a leveraged unwind, but kind of the most recent, I would say, market explosion that we saw in the beginning of February, where you had sort of some rockiness to the market, and things really started to cascade, and liquidations started to stack up, and I think we dropped 20% over the course of an hour, which is a lot for a market, and I think kind of the crypto world we kind of forget how big of a move that is. And it became, this was on mainnet where, this was, we internally at Euler were literally looking at kind of liquidations happening and how expensive stuff was, and gas spiked to 600, which was sort of the biggest I've seen in a while, and that on its own causes some interesting kind of market freezing problems. But again, you pair this with everyone trying to unwind at the same time, and this is sort of a very clear direct impact of that, where everyone is trying to hit the chain at the same time, get out of these positions, and then all of a sudden no one can do it because liquidity's dried up, it's too expensive to interact with, and you drop 20% in an hour. Fortunately, the market actually handled this one pretty well, I would say. It did feel like a little bit of a, kind of a red scare where it looked like it could keep going down, but yeah, as these positions go up and leverage continues to build over time, this is just going to get worse and worse. So to repeat, like these trades are still kind of working at the moment, which is kind of an interesting dilemma because you can still go get 20%, you can still go lever that up and get 100% on these trades, and it's going to continue to work until one day it's not going to work anymore, and it's going to it will be, a bloodbath basically of whenever this really starts to unwind. And this is the reason I was titling this section a black swan is because these are sort of considered a black swan event where it's it's a 0.001% chance that it happens, but as we all know in DeFi, if it can happen, it will happen, and it's just really a matter of time. Kind of the way that I like to think the best ways to avoid those things are just to, adjust your personal risk tolerance to what you think is appropriate. Be aware of these risks, and then from a protocol level, size, vaults, size positions, and size caps accordingly. Set the risk parameters to something that's appropriate for the market and what you think the market can handle, and kind of take the whole dynamic of the market into account and not just your individual protocol. So where does Euler fit into this in both the good and the bad? So for those unfamiliar with Euler, Euler V2 is a lending platform. It's a interconnected vault system built in a modular way that allows kind of anyone to build and piece together any lending market that they want. It's structured where the kind of minimal unit is a vault, and vaults can be enabled as collateral for other vaults to sort of restructure or recreate any sort of lending market, whether that's isolated pairs or as sort of whole market clusters. And Euler allows for a collateral re-op application system, which means if you have asset A and asset B, you can enable them as collateral for each other. Then that means that your collateral can be borrowed out at the same time you're using it as collateral to borrow out another asset. Michael, our CEO, wrote a really good article about this. You can find it on our blog on sort of the trade-offs associated with that, which we'll talk a little bit about. But there's, like I said, there's been a big kind of focus on capital efficiency and reducing costs to borrow and allowing kind of scaling these positions up, which is great because, again, everyone makes more money. There's more usage. We can kind of bring more people into using lending markets. But again, this comes with a problem where you might run into situations where you're trying to unwind a position with some collateral, and that collateral might not actually be there. So what do we do? Initially, it's really all about kind of setting the risk parameters appropriately, making sure that you're sort of understanding this as a risk and setting sort of the caps and the LTV ratios to allow for that. And then when it comes to what happens in practice is, when there's something where things are starting to unwind and you're trying to take out collateral, it will, as collateral gets withdrawn and the utilization ratios go up, interest rates will go up for both depositors and borrowers, sort of really heavily incentivizing borrowers to pay back their position because they'll start to get charged, hundreds of percent, and maybe incentivizing other suppliers to get back in as well. And a couple other things on top of that I'll talk about sort of next in the next couple of slides. So how do we deal with this, and how do we think about this at Euler? The big one for us is setting up markets appropriately from the get-go. One interesting kind of feature about Euler, as I said, it's sort of a very flexible system that allows the building and the setting up of isolated markets. So you can have kind of one whole cluster that exists as all of the ETH derivatives, and you have a cluster that exists as all the stablecoin derivatives, and those can exist completely separately from one another. So if there's something that happens where there's one of the ETH derivatives blows up, it's not going to impact kind of anybody else in any other asset. Like I said, we have a very sort of dynamic interest rate system where when utilization starts to change around, interest rates are going to change around appropriately with that, allowing for sort of the market to determine what's an appropriate level of utilization and deposits and borrows in a vault. Going back to kind of how these are set up from the get-go, there's a lot of thorough analysis done by kind of us and external risk managers on what LTVs should be, what risk parameters should be, what interest rate models should look like, so that we can sort of avoid any kind of catastrophic scenarios in the best way that we can. And also, one kind of feature that we've worked on a bunch is sort of whether or not things are governed or ungoverned, and fortunately we allow for both, which allows for, on the one hand, doing fully ungoverned immutable markets, but on the other, allows for governors to retain the option to kind of change parameters appropriately as market dynamics shift around, which can mean raising and lowering caps as more liquidity comes in and out, changing interest rate models and things along those lines to sort of best match what the current market scenarios are. One other big feature that helps kind of Euler stay safer in these scenarios is our liquidation system, which I think a lot of people might be familiar with, but it operates as kind of a reverse Dutch auction is what we like to call it, which is essentially kind of a scaling liquidation bonus as accounts become unhealthy. And what that means is that liquidations can happen very quickly and very early at a very low cost to the borrower. In our V1, I think the penalty was less than 1% for positions over $10,000, which is pretty good. And it sort of, it scales as positions go more and more underwater, which really incentivizes kind of liquidators to get in and kind of clear these positions out and keep the protocol safe in kind of a quick, efficient way. Again, as I mentioned, sort of quickly or carefully scaling deposit caps and market sizes. And then on the other hand, we're also like to take sort of a fully customizable approach to kind of interesting new trades and markets that are emerging over time that we think pose interesting opportunities for people. But again, done in a careful way where you can sort of start small and kind of scale into it as it becomes more and more stable. And that's sort of it. Feel free to pop into our Discord or check us out at app.euler.finance or follow us on Twitter, or we'll be around. We have a booth here for the main conference. And thank you.
codes and to do